Welcome to a fantastic edition of our Billions educational series. We're looking at the recent bubble of GameStop and AMC through the lens of a brilliant book that a friend of mine, actually Dr. Paleologo, just put out. Gappy, thank you so much for coming on today.
Hi, how are you? Nice to talk to you.
I'm doing great. We're so honored to have you. You know, of all the guest lecturers I've ever had for my students, I would definitely put you at the very top. Your work was at a mathematical level I'm not at. And, I'm a very, very honest and open person, and was very impressed by you and what you were up to. And so to have you on today to talk about today's, recent event of this crazy bubble we're living through is just fantastic. So please, tell
That's
us your
awesome,
insight.
right?
Well, your book also represents essentially the polar opposite of what Melvin Capital did over the last 30 days.
Kind of. So actually, let me give a little bit of my hot take on what's going on right now. Okay, so first of all, I think that I, or almost no one, right, in the world would have been able to foresee this. And if somebody can tell you when, GameStop is going to tank, it will happen, but timing is impossible. So I just want to say, this is beside the point for me. I would just like to say, though, that these things happen so often that considering them outliers or exceptional events, I think it's out of the place, right? So we had the mother of all squeezes with Volkswagen. We had a 2016 hedge fund.
Yes, Volkswagen very shortly became the largest company in the world. I think it had a market cap of over $1 trillion because of the 2008 short squeeze on hedge funds. And
and the mechanics, by the way, of these squeezes is always slightly different, right? So in the case of Volkswagen, basically the story was the float for Volkswagen was much, much lower than what people expected, right? In this case, it's a retail-driven short squeeze, magnified by the large open interest in calls, and so the gamma hedging. So there are different mechanics. In 2016, newspapers barely talked about this stuff, but in 2016, hedge funds had a major drawdown, and in that case, the trigger was a change in macroeconomic expectations, the ability for a few companies to refinance. So Seadrill and Chesapeake, explorers and producers, right, had basically an extra lease on life. And there was a massive short squeeze on these companies and a few others. Hedge funds lost a lot of money in that. Now, why I think this is interesting, I think it's a nice entry point to discuss the book that I'm going to plug shamelessly. So,
Advanced Portfolio Management, a Quant's Guide for Fundamental Investors. This is a book that, in my opinion, anyone who wants to program a portfolio should read.
Yes, actually, I have an even wider goal. So here is my goal, but I want to go back to GameStop because that's a good example. But I would say, so this book that I am done writing now, it's in the editing process. This book will come out in June, pretty much, of this year, and here is my reason for writing it. I mean, the primary reason to write this book is that I have a lot of friends who are portfolio managers and analysts that I have accumulated over the years. And they always ask me, what should I read in order to convert my ideas, I am a great stock picker, into profitable portfolios? Because over and over, they realized that having great ideas is not sufficient. By the way, if you read The Man Who Solved the Market and A Man for All Markets, these are two biographies. One is of Jim Simon and the other one is of Ed Thorpe. You will find buried in the book that what made a big difference both for Renaissance and for Princeton Associates is that they cracked the way to build portfolios out of their ideas. Okay, so the missing link between ideas and signal detection and making money is build a portfolio, okay? Make a portfolio. And many PMs, fundamental PMs, ask me, what should I read? And the answer was always, well, there is not much, but you should read a book by Greenwald and Kahn called Active Portfolio Management that was written about 21 years ago.
Yeah, I got that right over there.
Yeah, everybody has it. I think it's a great book, but it's a long book. It's a book written for quants, and it's a book written for quants of 20 years ago. So it is pretty much straightforward mean variance optimization and corollaries, okay? So a fundamental PM has a very hard time understanding what it's saying, what are the messages. And even after doing that, it's not completely clear whether these ideas nowadays would work for him or for her. So I spent a lot of time with PMs. I have thought about their problems from a quantitative standpoint, and then I have tried to distill the message, the quantitative insight, into heuristics that get them 80 to 90% there, right?
So with GameStop, obviously they need to constantly, if that's one of their shorts and they're adhering to your book's principles, they're going to need to be repositioning that on almost a daily basis. Yes. But they'll be able to stay with that position on the long term.
Yeah. So here is where I think GameStop or COS or AMC are interesting. In a way, and I'm not meaning this as a criticism to Melvin. If somebody from Melvin is reading this, I would love to talk to them in a very friendly way. But the fact is, there are a couple of things. The first is in a factor neutral portfolio, in a dollar neutral portfolio and beta neutral portfolio, in general, shorts make relatively less money than the long side. Even if you look at the factor, the idiosyncratic returns.
Now, well, that's just nature.
Yeah, but I'm not just looking at total return. I'm looking at the returns in excess of systematic returns of the market and other factors, right? Even so, the shorts tend to be less profitable. The shorts have a role, primarily, I've played three roles: risk management, right? Because they counterbalance some of the systematic exposures that the portfolio has; leveraging, because they allow you to leverage your book more, okay? And then there is a third role, which is alpha. They will make a little bit of money for you. But the short side of the book faces really fundamental problems. The first one is you have basically unbounded losses. So you need to have some kind of stop out at the stock level, not only at the portfolio level. And if you have a stop out at the portfolio, at the stock level, you have to think very carefully what that should be, right? It should be high, should be small. Am I going to exit a position too early because I have a stop out on, let's say, AMC or GameStop? So that's number one. Number two is the value of diversification. So in general, portfolio managers tend to be very confident about their conviction levels, and probably more confident on average than what the data bear. And diversification is very important. If you have a diversified...
Yes, confidence should not affect your exposure level on a percent basis of the portfolio, in my opinion. Mm-hmm. Confidence should only affect the ability for a prediction to be considered for inclusion in a portfolio. As far as I'm concerned, mm-hmm. confidence ratio is not a reason to buy more of a stock. And there's never really reason to buy more of a stock. Your exposure levels, in my opinion, should mm-hmm. be predetermined before you start trading.
Okay, so I am probably a little bit more agnostic with respect to this. I would say this. In the book, there is a chapter on ex post performance analysis. So understanding your past performance is important, right? And one of the things that matter in the performance of a portfolio manager. There are really three things that matter, right? Stock selection, sizing, and timing. And for a portfolio manager, typically the order is stock selection is the most important component, right?
But in regards to timing, if Melvin Capital had been able to stay with it, most people, like Jeremy Siegel, the Wharton professor, said last Friday, expect GameStop to go back to the $5 to $10 to $20 range, where then Melvin Capital would be extremely profitable again on those trades. But because of their exposure level, they will not be able to participate in the full cycle.
Yes. In my experience, timing skills, which you can measure of a PM, timing skills are by far the smallest contributor to performance. In fact, timing typically is contributing 0 to the performance of a portfolio manager. But I would say, don't take my word for it. There is a method to quantify these three components. And I think every PM, and this is, by the way, not too hard to implement even in an Excel spreadsheet. Okay, this is one of the things you can do in an Excel spreadsheet, no problem. And it should be done. It should be revisited on a quarterly basis. And if you have, if you have sizing skills, great. Doesn't mean that you can go crazy anyway, but that's great. It means that you can convert your ideas into more or less proportional sizes. But if you don't, then be more careful. That's the message. If you have timing skills, that's great.
A good optimizer can greatly enhance performance in certain years. Greatly enhance.
Yeah. So optimization. Okay. So that's a good topic also.
Would a good optimizer have allowed a short stay with GameStop?
I think that you would not need an optimizer to avoid a GameStop short squeeze. You don't need an optimizer to do that. If you have an optimizer, if you have somebody who is going to implement an optimization system for you in Fundamental Manager, or if you are a retail investor, but you're a quant retail investor, so you know enough math to do it, then you can do better because you will save some of your time and you will have some additional efficiency. But it's not absolutely necessary. As a matter of fact, I know several portfolio managers who have made literally billions of dollars for their hedge funds, and they have used optimization provided by me or people in my teams only occasionally when essentially their portfolio was painting itself into a corner, right? The portfolio was really out of shape. And then you cannot just trade here and there. You are much better off running an optimization and putting the portfolio back in shape. But for most of their time, they didn't really need an optimizer. No. So there is a great portfolio manager who is now his own hedge fund manager, who always ran portfolios that were very pure in the sense that they had very little factor exposure. As a matter of fact, now runs a portfolio in his hedge fund that has 90% percentage GDO variance. So it's a very, very factor-free portfolio. He never uses optimization.
I have a question. Do you feel bad at all for Robinhood? I kind of feel a little bad for them. I don't think they did anything particularly wrong. They had to put up 1% to 2% of a trade.
Yeah.
GameStop was trading $25-50 billion a day. They just can't afford to clear to the settlement percent of all those trades for the exchange, unless you believe this conspiracy theory that Stevie Cohen and Ken Griffin called up Robinhood and said, oh, you must stop that, which I think is absolutely hocus pocus.
Okay, so now we are in the realm of complete hot takes in the absence of, accurate information. So
100%.
Let's take it really with a grain of salt, because I am not.
My apologies. We can.
Yeah, but I would say,
if you prefer.
Right, I would say this. I would say, a couple of things, just as a cautionary tale to all the retail investors who are listening to your podcast. Okay, so number one. It's nearly impossible that Citadel Securities or Citadel Asset Management have interfered with the operations of Robinhood.
Yeah.
This is pure conspiracy.
I know, but you have politicians going out there and speaking about it. I mean, I can't stand politicians. I will never have one politician on this show. In fact, we had the head of Princeton's some laboratory coming on the show, and then I found out that this person was also a councilman. I said, absolutely, we have to cancel this person. I will not have any politician on the show. This is a learning show. Politics, sex, religion, and personal have no place in a learning environment. And so, I have 135 students, and the only way to manage that many students is to be focused on education.
Yeah. So if we stick to the facts, I think Robinhood has said they didn't, but it's not only that, is that Citadel Securities is an organization that is extremely careful to respect the spirit, I think, and the letter of the law. They wouldn't do it.
Of course.
Everything is possible. Let's not go into these conspiracy things. Now, the other thing is, Robinhood has to clear its trades through a clearinghouse. Clearinghouses have become a predominant player to control clearing risk, right? So trade risk in a sense, and they have rules. They have a methodology for the posting of collateral. Okay, and this is basically the sum of several pieces. So there is a piece that is essentially a value at risk piece. So if the volatility, for example, of a stock increases, you want to require a higher margin, right? Because that's in the nature of things.
Of course.
Then there is a jump to default component. Then there is a portfolio component. So if Robinhood has a certain portfolio of trades, if the portfolio becomes riskier, they have to post more collateral.
No, of course. I don't see what they did wrong here. And maybe it's because I've been operating an asset management firm for 15 plus years. And so I understand what fiduciary responsibilities must be taken at certain times. So I don't know. I don't see what they do. Do you see anything can you see anything from your vantage point that they've done wrong?
So I don't see it. I cannot say that they did nothing wrong. I cannot say it, but at least I can say that what people say that they did wrong doesn't seem obviously wrong to me.
Okay? Yes, so, exactly.
Maybe they did something wrong, but it's definitely not because they suspended the purchase of GameStop because they cannot actually sustain it. Well, they would be in breach. The other thing that was said that I've read, I don't remember on Twitter is, but they have their own clearinghouse. That explains it. That is not. That's not the issue. A clearinghouse is is member or it's member owned. It's a sort of mutual insurance scheme. So the fact that Robinhood is running one doesn't mean that it's exclusive to Robinhood. So these things seem a little bit hysterical. I don't know.
No, I agree with you.
Yeah, from a portfolio perspective, though, from an investment perspective, it's a very interesting case because it's going to tell you that, first of all, these outliers are not really outliers. This is part of the business. When you have drawdowns in 07, 08, 14, 16, 18, 20, and 21, and all of them involve some kind of massive de-risking, some kind of massive short squeeze with different mechanics, these are not outliers anymore. If they're not outliers that happen once every 10 years, they happen every 2 years, you have to include this extreme risk into your portfolio management, because if you don't, then you will be somebody who's posting 30% returns for 6 years in a row.
They were grabbing nickels in front of a bulldozer.
Exactly. And so this is going to be an LTCM. This is going to be a potential Melvin. I'm happy that
just like LTCM had the stupidest portfolio management I'd ever seen. LTCM was one of the inspirations for how diversified Rebellion research is. Mm-hmm. So I can't even begin with that.
Can I recommend a book? I mean, we are.
Oh, please. We love book recommendations.
So there is a book that somehow, I don't know, it's underrated to me. It's called A Crisis of Crowding, and is by Ludwig Chiarini. Find it out on, it's published by Bloomberg. And it has two parts in this book. One is the 2008 crisis, viewed from crowding and de-risking. And the other one is LTCM. And it goes into the detail of how LTCM was managing risk. I think Chiarini worked at LTCM, he's a professor now. The trades that they were running. So if you're curious about what type of relative value trades they were running in fixed income, it's all there. It's really interesting. And how they did risk management, right? So yeah, but you know.
Well, we're coming to the conclusion of our show. So before we end, thank you so much for all this conversation. I want to recommend to our viewers that they buy Advanced Portfolio Management, a Quant's Guide for Fundamental Investing. I reiterate that all I do is spend all day long with some of the smartest AI minds on the planet. And Gappy really impressed me, and I think that everyone would benefit from owning this book. And I don't often say that. I really only, endorse books from writers who I greatly respect. So,
well,
Gappy,
can I say, first of all, thanks a lot. You're a friend, so.
Thank you. I would, if anything, I would hold you to a higher standard because we've been friendly.
So perfect. Yeah. So we didn't talk much about the book and what's in the book, but
they need to buy the book to find out what's in the book. Okay. They came on the show to hear about you and to get excited about you, which is what they did. Now they're going to go and click on the buy the book button, which will be on the webpage, which will direct them to Amazon where they can buy the book. That'll come out in June. And hopefully a number of business schools will buy this book as well. And this is fantastic work, Gappy. Be well and stay safe, okay?
Take care. Thanks a lot for having me.
Oh, no, my pleasure is all mine. Come back anytime. Bye-bye.